What if I told you that a major, highly conservative European bank just bet a massive chunk of its volatility budget on a high-stakes stock thesis written by an anonymous internet influencer?
It sounds like a joke, honestly.
Right. But today, we are looking at a diagnostic landscape for a specific company that is just incredibly polarized. Welcome to the deep dive. We are taking you right into the center of an intense valuation debate surrounding a Swedish tech hardware company called Sivers.
Yeah, that's trading under the ticker SIVE. And, it is a phenomenal case study in what happens when localized traditional market analysis just crashes head-on into the sheer speed and scale of modern global tech supply chains.
And the sources we have for you today provide a brilliant cross-section of that exact crash. We are looking at an excerpted analytical text from an independent investor, side by side with a news clipping from Nyhetsbyrå Direkt via the Swedish financial publication Affärsvärlden.
It's a really interesting mix of perspectives.
It really is. Our mission today is to navigate these wildly contrasting viewpoints. Because on one side, we have cautious Swedish media. On the other, an anonymous internet influencer with a massive following. And throwing their weight into the ring alongside the influencer is an actual major European bank. We are going to figure out exactly what is driving predictions of a literal 10x growth for Sivers. Okay, let's unpack this.
Yeah, the catalyst for all this attention is definitely where we need to start, because before we touch the data center mechanics or the underlying photonics, we have to look at the incredibly unlikely source that ignited this entire narrative.
Right. I mean, this didn't start with a dry press release from a corporate boardroom.
No, not at all.
This started on Platform X with an anonymous writer who goes by the handle Serenity. And this account boasts over 200,000 followers. Over the past month, they have been aggressively posting incredibly positive sentiment about Swedish Sivers.
Which is pretty unusual for a Swedish hardware stock,
Very. And we need to get our numbers and currencies straight right out of the gate here. So Sivers currently has a market capitalization of roughly 990 million Swedish krona.
Which, for context, is slightly under 100 million US dollars.
Exactly. But Serenity is predicting a path for Sivers to hit a 10 billion SEK market cap.
So we're talking about roughly a 10x increase from its current position.
10 times. And the kicker is that Serenity is predicting this could happen in just 1 year.
Wow.
Yeah, naturally, this kind of explosive, almost meme-like prediction triggered a massive reaction. Several Swedish media outlets have recently stepped in to issue stern warnings about the stock's rapid and sudden rise. But let me challenge this entire premise.
Let's go for it.
Does an anonymous influencer actually have the technical receipts to back up this kind of extreme 10 billion SEK hype against the media's skepticism? It feels a bit David versus Goliath, retail influencer versus traditional media. Or are we just looking at another cycle of retail euphoria pumped by a big follower count?
What's fascinating here is that when you actually read the source text, you realize Serenity's argument is entirely stripped of standard internet hype.
Wait, really?
Yeah, I mean, it is deeply rooted in very specific, highly technical hardware metrics. They are arguing that Sivers laser manufacturing is poised to scale proportionally to some of the most massive tech volume outputs on the planet.
Oh, interesting.
They aren't relying on a catchy slogan. They are pointing to supply chain bottlenecks that Sivers supposedly solves.
Well, let's actually look at those bottlenecks then, and how Sivers fits into the broader tech ecosystem. Because Serenity ties Sivers' potential laser volume to an absolute alphabet soup of major players in technology.
There's a lot to take in, yeah.
The source specifically mentions Apple Watches, JBL 1.6T volume, MRVL CPO volume, Ayar, and POAT volumes. For anyone not building data centers for a living, what are we actually talking about here?
Let's translate those acronyms because they really are the foundation of the 10x thesis.
Yeah.
When Serenity mentions MRVL and Ayar, they're talking about Marvell technology and Ayar labs. These are the heavyweights designing the next generation architecture for artificial intelligence computing. And the core technology they're utilizing is called CPO, or co-packaged optics.
Co-packaged optics. I've seen that term floating around a lot lately regarding data centers. Why is CPO suddenly so critical?
It comes down to the absolute physical limits of copper wiring. As AI demands faster and faster data transfer speeds, what the source refers to as 1.6T or 1.6 terabits per second, traditional copper wiring just physically fails.
Because of the heat.
Exactly. When you push that much data through copper, it generates an immense amount of heat, it consumes massive amounts of electricity, and the signal degrades over incredibly short distances.
Yeah.
I mean, copper is literally choking the AI revolution. The only solution is to use light.
So fiber optics, we're talking about replacing the electrical signals with lasers.
Precisely. But CPO takes it a step further. Co-packaged optics means you aren't just plugging a fiber optic cable into a server rack. You are taking the microscopic laser and packaging it directly onto the silicon chip itself, right alongside the processor.
Wow, okay. That's incredibly small.
Right. MRVL, Ayar Labs, and POET Technologies are building these integrated chips. But they need the actual light source. They need the microscopic lasers to power them.
And according to the source, Sivers is supplying those lasers to all the next generation of these 1.6T and CPO players.
Exactly.
Which means Sivers is feeding directly into the supply chains of the hyperscalers. The source specifically names AMD, NVIDIA, Amazon, and Microsoft as the end users.
Yeah, so Sivers is positioning itself as the foundational supplier. If NVIDIA and Amazon are building the AI cities of tomorrow, MRVL is laying the pipes, and Sivers is providing the water.
That's a great analogy. But wait, supplying lasers to existing players at a 990 million SEK cap is great, but the source text includes a massive caveat.
The qualification risk?
Right. It says all of this scaling is dependent on, quote, how their qualification plays out into volume ramp. Like, getting a qualification from an Ayar Labs or a MRVL doesn't automatically put cash in the bank tomorrow, does it? Isn't this assuming the absolute hardest part, which is manufacturing millions of flawless lasers, is just a given?
That mechanical hurdle is exactly why the Swedish media was issuing warnings. Let's break down the difference between qualification and volume ramp because it is the entire ballgame for hardware companies.
Please do.
Qualification means a giant, like Apple or Amazon, has tested your prototype component, they verified that it works perfectly under extreme stress, and it meets their exact specifications.
But qualification is essentially just passing a very rigorous audition.
Exactly. You proved you can act, but you haven't shot the movie. The volume ramp is the actual production. A volume ramp isn't just doing the same thing faster, it is the difference between a master chef cooking one perfect Michelin star meal in a sterile lab and having to design a factory that produces 50,000 of those exact meals an hour.
Without a single drop in quality.
Yeah, right.
And we are talking about photonics here. I imagine the margin for error is essentially zero.
We are talking about atomic level precision. When you scale from making 10 perfect lasers to 100,000, you run into microscopic heat challenges, alignment shifts on the factory floor, and supply chain material shortages. I mean, a volume ramp can easily bankrupt a company before they yield a single dollar of profit.
Jeez. So the Swedish media is looking at a sub-$100 million company and saying the odds of them building the Michelin star factory without stumbling are incredibly low.
Yes, that's the crux of their skepticism. But if Sivers clears that hurdle, the dynamic changes entirely. Clearing the volume ramp opens up massive TAM, total addressable market expansion.
Right, because it proves to everyone they can do it.
Exactly. It proves to the entire semiconductor industry that you can deliver at scale, which instantly attracts more hyperscaler partnerships. That is the asymmetric bet investors are looking at.
So if a highly resourced bank and a retail influencer are both looking at the exact same supply chain data and seeing a 10 billion SEK future, what exactly is making this bank comfortable with that volume ramp risk?
That's the million-dollar question.
Because you expect a traditional conservative banking institution to firmly side with the cautious media. Bank money is usually safe money. But the sources reveal a massive twist here.
We actually see a major institutional player stepping right into the middle of this debate and validating the influencer's core thesis with real capital.
Enter DNB, one of Europe's leading banks. Specifically, we are looking at Auden Wickstrand Iverson, who is described as a technology activist at the bank. He goes on the record with Affärsvärlden and publicly agrees that the anonymous influencer Serenity is onto something real.
It is an incredible moment of narrative crossover. You have a formal banking executive publicly nodding along to an analysis published by a pseudonymous account on Platform X.
Iverson gave a quote to the Swedish press that is just wild to hear from a banker. He said, "I don't want to say that it's most likely, but it's clearly within a fallout room that this is a company that could be worth between SEK 50 and 100 billion.
Wow.
So he's projecting an even higher ceiling than Serenity's 10 billion SEK target. And DNB didn't just offer lip service. Their Disruptive Opportunities Fund bought into Sivers in early April and participated in a recent directed share issue.
And for those unfamiliar, a directed share issue means Sivers created new shares and sold them directly to institutional investors like DNB, completely bypassing the open market.
Which gives them cash instantly.
Right. It is a way for a company to rapidly secure the massive upfront capital they need to actually fund that expensive volume ramp we just talked about.
So they are handing them the cash to build a Michelin factory.
Exactly.
And Iverson's projection aligns with Serenity's 10x return, though importantly, Iverson operates on a slightly more conservative timeline. While Serenity called for a 10 billion SEK market cap in 1 year, Iverson is projecting that 5 to 10 times return over the next 3 years.
That expanded timeline is a crucial detail regarding institutional risk management.
Here's where it gets really interesting. Iverson made an admission about this investment that perfectly illustrates that risk management. He told the press that this investment will, quote, eat up a large part of our volatility budget because it will swing.
The volatility budget.
Volatility budget. He is flat out admitting that this is not a safe sleep-at-night dividend stock. He expects the stock to swing violently up and down.
This raises an important question. Why would a major bank willingly subject itself to that kind of violent structural shock? It connects right back to extending the timeline to 3 years.
How so?
The bank understands that scaling photonics is messy. There will be delays, there will be missed quarters, there will be sudden panic selling by retail investors who don't understand the manufacturing cycle. That is the volatility.
So they are padding the timeline to absorb the inevitable, disastrous quarterly earnings reports.
Precisely. The fact that a major institutional bank is openly aligning its capital with this thesis signals that the underlying technology, those specific lasers feeding the CPO architecture, is so fundamentally disruptive that traditional risk models are being rewritten.
They're throwing out the rulebook.
Yeah, they're willing to burn their volatility budget because the asymmetric upside of owning the hyperscaler supply chain is just too massive to ignore.
This paints a picture of two completely different financial philosophies colliding. If the technology is this solid and a massive bank is actively funding the volume ramp, why on earth was the Swedish media issuing warnings? The source text dives deep into this, actually arguing that this isn't just a disagreement about Sivers lasers. It is a fundamental cultural and geographic divide in how stocks are valued.
Right. The author of the source text points out a structural difference between how markets operate in the United States versus how they operate in Europe.
The text highlights that Sivers now has a secondary listing on the U.S. NASDAQ. And the author points out that U.S. institutions are inherently forward-looking. Like, they tend to price stocks roughly 12 months ahead of time based on total addressable market.
Exactly.
But local European valuations, by contrast, mainly look backward. They base a company's worth heavily on the previous 12 months of performance.
And you can see exactly why this creates incredible friction for a hardware company.
Oh, absolutely.
If you value Sivers based on the last 12 months, you see a small company with a sub-$100 million market cap, burning cash, trying to figure out how to scale a complex laser factory. By European metrics, it looks wildly overvalued and incredibly risky.
But if you flip it...
Right. If you value them based on the next 12 to 36 months, assuming they successfully ramp up volume for MRVL, NVIDIA, and Amazon, they look profoundly undervalued.
Why is there such a stark difference, though? Is there a reason European markets are so rigidly backward-looking compared to the U.S.?
It generally comes down to market culture and risk capital availability. European retail and institutional markets heavily favor steady dividend yields and predictable quarterly growth.
Which hardware is definitely not.
Right. Hardware manufacturing is the antithesis of that. Hardware requires a massive upfront capital expenditure, a huge burn rate, long before a single laser is ever sold at scale. It destroys quarterly earnings in the short term. The U.S. NASDAQ, however, has a high tolerance for massive burn rates if the company is capturing a disruptive new market.
The author of the source text actually makes an impassioned plea about this. They argue that Europe needs to embrace the positive sum growth of their own companies that supply these hyperscalers.
Yeah, it's a strong argument.
The argument is that supporting local frontier companies provides massive long-term benefits to the local economy. Tax revenue, general economic growth, and job creation in high-tech sectors.
The author explicitly warns that if local markets don't support these capital-intensive companies, they might never mature into global players. They use the U.S. ticker symbol LITE Lumentum Holdings as an example of what Sivers could become, a massive multi-billion-dollar established optical component supplier.
Right.
But reaching that status requires capital and patience that a backward-looking, dividend-focused market simply might not provide.
So what does this all mean? I have to ask, looking at this structurally, is the European backward-looking method a fundamental flaw that stifles local innovation? Or, considering the massive volatility and factory risks we just talked about, is it actually a highly functional defense mechanism to protect local retail investors from getting burned by tech hype?
If we connect this to the bigger picture, it serves as a defense mechanism, sure, but one that actively starves innovators. The Swedish media's warnings are doing exactly what their local market structure demands. They're protecting the retail investor from buying at the absolute top of a hype cycle, only to watch the stock crash when the volume ramp inevitably hits a snag.
Because retail investors don't have a massive volatility budget to absorb a 3-year roller coaster like DNB does.
Exactly. However, the author's macro argument is critical here. Valuing a frontier hardware company strictly on past profitability severely handicaps it. If your local financial ecosystem punishes you for that initial unprofitability, your share price drops.
And if your share price drops, you can't raise the capital.
Right. You can't fund the volume ramp. You are starved of the very oxygen you need to grow into that 10 billion SEK valuation. It becomes a self-fulfilling prophecy of limitation.
It is like judging a marathon runner's potential by evaluating their heart rate while they're still tying their shoes at the starting line.
That's exactly it.
Meanwhile, the U.S. markets are essentially placing bets on the runner's finish time before the starting gun even fires.
It is a fundamentally higher risk profile, but historically it has been the only effective way to fund truly frontier technology at a global scale.
This has been an incredibly revealing deep dive into the hidden mechanics that actually move tech hardware markets today. For you listening, let's quickly synthesize the journey we've been on. We started with this fascinating collision, an anonymous internet influencer named Serenity predicting a massive 10x growth for Sivers, targeting a 10 billion SEK market cap, while traditional Swedish media flashed warning signs.
And we explored the complex physics behind that bold prediction. Sivers' optical lasers are positioning themselves to solve the physical limitations of copper wiring. They are the light source for co-packaged optics, powering the massive next-generation data supply chains for hyperscalers like NVIDIA and Microsoft.
But it wasn't just Platform X hype. We saw DNB, a major European bank, step in and validate that tech potential with a directed share issue, projecting a 5 to 10x return over 3 years. And that's even if it meant eating up their entire volatility budget to weather the manufacturing storms. Finally, we looked at the deep structural divide between forward-looking U.S. capital markets and backward-looking European models, and how that impacts the survival of hardware startups.
As a final thought for anyone analyzing this space, it is crucial to keep your critical thinking at the forefront. The mathematics of a 10x growth potential are undeniably alluring, especially when tied directly to the AI hardware boom.
Oh, sure.
But remember the mechanical realities we discussed. The jump from a successful qualification to a flawless volume ramp is a perilous crossing that has broken many companies. There's a very tangible reason a major bank designated this as a primary consumer of their volatility budget.
It is going to be an incredibly bumpy ride for anyone holding the ticket.
Yeah.
And that leaves us with one final lingering thought for you to mull over. We unpack the friction between these different valuation cultures. The U.S. tolerance for cash burn versus the European demand for past profitability. But think about the long-term consequences of that friction. If a local European valuation system naturally restricts the growth of its own frontier companies by punishing the capital expenditure required to scale, could this financial culture eventually force the most innovative European tech hardware firms to entirely abandon their home exchanges and flee to the U.S. NASDAQ just to survive?
It is a structural dilemma that extends far beyond just Sivers or photonics.
It really does. It changes how we look at the global map of innovation. Thank you so much for joining us on this deep dive into the sources today. We will see you next time.